Welcome back. In our previous week, we examined the regulatory framework governing microfinance, including key regulatory bodies, compliance requirements, and the impact of government policies. Now, we shall explore microfinance delivery methodologies and dive into the strategies that make microfinance accessible and impactful. Now, meet Asha, a small farmer in this rural community. Just a few months ago, Asha lacked the resources to expand her farm. Like millions of others, she didn't qualify for the traditional bank loan. However, her life changed when she discovered microfinance. Through a local microfinance institution, Asha received a small loan to invest in seeds and equipment. Today, we will explore how these microfinance institutions work to deliver financial services to people like Asha, focusing on the loan cycle and the innovative lending mechanisms they use. Microfinance institutions have a unique way of working, offering financial solutions to underserved populations through a well-defined loan cycle and lending mechanisms. The process starts with a loan cycle, a step-by-step approach that guides both the lender and the borrower from application till repayment. Now, let's look into loan cycle overview. The loan cycle consists of 6 phases: loan application, appraisal, disbursement, repayment, monitoring, and loan closure or renewal. Each phase plays a critical role in ensuring that both borrower and the microfinance institution are safeguarded from undue risks. Starting with loan application. The loan application marks the beginning of the process. Unlike traditional banks, MFIs cater to clients who often lack formal credit histories, documentation, or even collateral. This is where the flexibility of microfinance institutions come in. To begin, they will need some basic information about your household income and what you plan to use the loan for. They also offer 2 types of applications: individual or group-based. In group-based lending, a small group of borrowers applies together and acts as a collective guarantor for each other. This model works especially well in tight-knit communities where social pressure encourages on-time repayment. On the other hand, individual applications focus solely on borrowers' financial capacity. Next, loan appraisal. Once the application is submitted, the MFI conducts a loan appraisal. This involves assessing the borrower's financial situation and business potential. In many cases, officers visit the borrower's home or businesses to get a clearer understanding of their income, expenses, and how the loan will be used. Risk assessment is crucial in determining whether the borrower can repay the loan. In some models, like village banking, community lenders, or committees may participate in vetting the borrower. These social structures can be powerful in managing risks. Third step, loan disbursement. Once approved, the loan is disbursed. Depending on the borrower's location, disbursements can be made in either cash or electronically through platforms like mobile wallets. In rural areas where digital banking may not be accessible, cash disbursement is still very common. In some cases, disbursements come with conditions. For instance, if the loan is intended for a business, the borrower may need to show proof of investment before receiving the full loan amount. Next step, loan repayment. Loan repayment is perhaps the most critical phase of the loan cycle. MFIs typically offer flexible repayment schedules with terms ranging from 6 months to 2 years. Borrowers can choose weekly, bi-weekly or even monthly repayments depending on their cash flows and business operations. For group loans, repayment is a collective responsibility. Social collateral ensures that each borrower not only repays their share but also helps others in the group stay on track. If one member struggles to pay, the rest of the group steps in to cover the shortfall. Interest rates in microfinance are generally higher than those in conventional banking due to the risks involved, but they are much lower than those charged by informal money lenders. Next step, monitoring and follow-up. Throughout the repayment period, MFIs closely monitor their clients. Field officers conduct visits, and in group lending, peers also play a role in monitoring. Digital tools. Digital tools are increasingly being used to track payments in real time, helping MFIs manage loans more effectively. Sixth, loan closure or renewal. Once the loan is fully repaid, it's time for closure or renewal. Borrowers like Asha may receive formal recognition for successful repayment, which helps them access larger loans in the future. Repeat borrowers often enjoy better terms such as lower interest rates or larger loan amounts. Now let's look into the lending mechanisms in microfinance. Microfinance institutions use various lending mechanisms to meet the diverse needs of their clients. Group lending is one of the most popular models, leveraging social pressure to ensure repayment. Individual lending, on the other hand, is typically reserved for more experienced borrowers who have already established a good credit history. Some MFIs also employ hybrid models that combine group and individual lending features. For example, borrowers may start with a group loan and later graduate to individual loans as they build their financial credibility. In conclusion, the loan cycle and lending mechanisms in microfinance are designed to provide financial services to the underserved by carefully managing risk, tailoring products to meet the needs of the clients, and fostering community involvement. Microfinance institutions can create a sustainable pathway to the financial inclusion. Asha's stories is just one of the millions. Microfinance continues to change lives with one loan at a time, offering hope and opportunity to those who need it at the most. Thank you and stay tuned.